as well. So, like I said, thank you for joining us today. I really appreciate your attendance today and future attendance at other workshops we might be hosting. A little bit of information about Mission West before we get started. So, my name is Weston Keene. I'm the business development manager here at Mission West. Mission West is an organization based in Ronan that's been here since 1995, and it's built up of four different departments essentially. So, first is the Food and Agricultural Development Center, or MMFEC, in the back. So, that's a shared use USDA approved food processing facility. They work with a lot of food and agricultural based businesses, like the name implies. So, any food startups or any businesses that might need access to a commercial kitchen or processing facility, that's a great resource for them. And they're always happy to work with new clients or anyone that might be spitballing a new idea. We have our Cooperative Development Center, and they work primarily with cooperatives. Some notable examples of some cooperatives they've worked with is the Ronan Cooperative Brewery in Ronan. They're working with Glacier Processing up in up in Columbia Falls. They're working with the new tribal meat processing facility and doing some support with them, as well as some work over in Idaho and Washington with some pretty exciting projects in those areas as well. Then we have our Community Economic Development Center. They're working on quite a few different projects in that department, but primarily they're part of the team that's working on the Ronan Revitalization Project that the Ronan Chamber of Commerce is heading up. So Taylor's a great resource for a lot of those projects and other community-based projects that might be happening in our three-county region. And then we have our Business Development Center, and that's the organization I'm with. And Taylor's waving right there, so if you have any questions for him, he's on today, and I'm sure he'd be happy to connect with you about some of the work that they're doing out of that department. But they're kind of a great bridge between all of our departments here at Mission West, and he does a great job of connecting different community groups in the area with resources that we have available here at Mission West. And then the Business Development Center, like I was saying, we have our in-house loan department. John Whitworth is our loan officer, and he's worked with countless businesses over his time here. And then we have a technical assistant network that Dave is a member of, who's going to be presenting today, as well as a few other members that provide financial support, money management support, HR resources, marketing. Really, if it has anything to do with small business, we probably have someone that can help you. And we also bring you these workshops here that you're attending today. But with all of that being said, and without further ado, I will turn it over to Dave Lagakos, who's going to be leading our workshop today.
Awesome. Thanks, Weston. I appreciate it. Appreciate everybody being interested in a very exciting topic, financial projections. I'll try to make it as interesting as I possibly can. Like Weston said, the Mission West program is absolutely amazing. If you're a business looking to get started or grow, highly recommend stopping in and talking to anybody at Mission West. They'd be happy to help you. In turn, a lot of people like myself will be more than willing to help you also. So without further ado, let me get my screen shared for everybody. Can jump into it. So today we're going to do a very high level overview of financial projections. So what's going to go on is I kind of have a case study going on with a coffee shop. So with this coffee shop, we're going to use this coffee shop as an example. We're going to show you some of the financial statements and then also how to do projections going off of that. Picked a coffee shop because everybody's familiar with that. It's very easy to understand. If people have any questions, feel free to come off mute. Be more than happy to do that or put it in chat. If stuff goes in chat, I'll try to pay attention. If not, Weston, please jump on and let me know if people have questions. A little bit about myself. I own two businesses along with many others, but my main ones are Intrepid Financial and Horizon Business Solutions. So my main focus is getting business owners to start their business, help them grow, bring financial clarity to their business and their personal lives. And then if you're looking to exit your business, I can also help with that. Some quick overviews, business value growth, transitions, financial clarity, and retirement plans. All right, so I'm going to ask some questions through this process. If people feel comfortable raising their hand, put it in chat, great. If I don't hear anything, I'll just kind of keep moving through everything. like I said, this is very high level. So a lot of this stuff, people take whole courses in college, multi-day courses to get through all this stuff. So it's going to be very high level. If you're an accountant or bookkeeper on this call, please don't, reprimand me for not going into more detail with some of this stuff. I want to be very basic so everybody gets a clear understanding for a starting point. If you have any further questions, we'll definitely be happy to help you. Let's start out with your financial statements. Does anybody know the three main financial statements? Let's just jump into it.
Looks like Rue answered in chat.
Okay. I need to get this chat up so I can
Yeah.
actually
So
see
Rue
this.
said P&L, balance sheet, and cash flow.
Awesome, Rue. You got it exactly right. I appreciate the participation. So what we're going to do is we're going to jump into each three of these as we go. So let's start with the P&L statement.
Question real quick. If you're just launching your business, and this, I guess, relate to this, you don't have any cash flow yet, but you know what products you're going to do. How do you kind of do, I guess, a projection is what my question is.
Yep, 100%. Yep, and we're going to get to that. So I kind of start with the baseline. We're going to do the financial statements. That's a great question. Just so everybody has an overview of what actually goes into the business, what you need to be looking at. We kind of need to start with that, and then we're going to jump into the forecast. So as a brand new business, you're obviously not going to have a P&L statement or a balance sheet or anything, but it's a good framework to understand. We're going to jump into a brand new business and how you actually start that forecasting here in about 15 minutes. So with this P&L statement, high overview, there's three parts of it. We have our revenue, or the sales that are coming into the business. We also have our expenses and we have our income. So what's left over from the expenses coming out of how much sales we bring in. So all these numbers that I'm going to have shown up here today are going to be translate into actual financial statements and forecasting that I've projected for this coffee company. So everything you see in here is going to directly correlate with stuff. So as you can see, we have our total revenue minus our direct costs and expenses gives us how much operating income we actually have. So what about our actual net profit? So is our net profit and our operating income the same number? When people say I made this much profit or I made this much income, is that usually the same number? Does anybody know? Let's look at it on the P&L. Kristen, awesome. No, it is not. Let's look at it on this profit and loss statement. So jumping into this, we can see this is the projections that we have going. So we are starting in 2025, 2026, and 2027. So I did this as I've already started in 2025. So I kind of have a general idea and I want to project forward. When it comes to forecasting, when we get to that exact topic, it's not really going to matter that much whether you have current income and expenses from the business or you're starting brand new. The forecasting part of it's going to be exactly the same. So Joshua, even though I'm talking that this company is already up and running, it's going to correlate with starting a brand new business also. And I'll show you that.
What about
top
variable
Yep.
costs?
Yep, and we're going to get into that too. Exactly. Yep. This is just a very quick overview so people can understand these statements, and then we're going to jump into the forecasting because they go hand in hand with each other. So on a profit and loss, you're always going to see your revenue up top. You're going to have your direct costs just down below, and you can kind of see here that we have coffee beans, milk and syrup, cups, lids, straws, everything that's going in as an expense for the company. Also in this revenue section, you can see each thing is broken down. We have our drip coffee, our regular menu, pastries, bottled beverages. You can see everything broken down on a profit and loss statement. This is a great way, a quick overview, because you can actually see which each revenue stream, how much you're bringing in, what's the exact cost of everything for a given time frame. So with our expenses, like we talked about, we're going to have direct costs, direct expenses, and we're going to have our fixed costs. So you can see there at the bottom that we had the operating expenses. Coming down further from the P&L statement towards the bottom, we're getting to this operating income right here. So that last question I asked, is our net profit the same as our operating income? Here's our perfect example. Our operating income was $24,000, but our net profit was only 21,500. There's a lot of extra things that we just don't have time to dive into this at the moment. But you have the interest expense, you have taxes, you have depreciation, amortization, you have all these other things that actually will come out of your operating income before you have your bottom line number. Now, that's a whole different topic to get into. We don't have time today, but if that's something you're interested in, we could definitely cover that in a future workshop. So here's kind of a golden rule that I always talk to my clients about, 30-20 rule. And this isn't something I came up with, but this is just a standard rule that larger businesses and smaller businesses can even go on as a framework. So what is a 30-20-10 rule? So in your business, you want to make sure that your gross profit margin, which we'll cover here in a minute exactly what that is at least 30%. You also want to make sure that your fixed expenses are only 20% of your total revenue. And you want to make sure that you're making that profit of at least 10%. Now, 10% is a very generic number. If you're a marketer, your profit is probably going to be a lot higher than 10%. If you're a grocery store, your profit's probably going to be 3 or 4%. These numbers aren't set in stone, but they're an easy number just to look at to see if your company is on track or not. So let's look at a couple numbers that actually correlate with this. So back to the coffee shop again. We have our revenue came in at 252. Our direct costs came out of that, and our gross profit margin is at 53%. So that's a lot higher than our 30% benchmark that we were trying to hit. So that is awesome. Now let's look at our fixed expense. Our fixed expenses were $110,000, and that came out to be 43% of our total revenue was going to fixed expenses. 43% is a lot larger than this 20% that we're shooting for. So that's an area right there, just by using this easy framework, that we can look into that a little bit further. Our operating income, somehow I did the math right, and it came out to be exactly 10%. So we know our operating income is doing awesome. Our gross profit is doing great, but our fixed expenses are a little high. So this is just an easy framework that you can put these numbers in very quickly and see where your company's at. Does anybody know what the 3 parts of a balance sheet are?
I think you might have do you have a question, Rue?
Oh, sure.
Yeah, so you're probably going to get into this later, but would a reason that the fixed expenses was 43% be high because it's a brand new coffee shop? They're having to buy equipment and all of this other stuff,
Yep, exactly.
and they don't have their cogs dialed in.
Yep, exactly. And we're going to get into that here in a minute. We're going to talk about cost of goods sold and your fixed expenses and how that correlates. But you're exactly right. When you're just starting up your company, your fixed expenses are going to be very high because you're just starting up, and you don't have your goal revenue coming in to offset those fixed expenses. So you're exactly right. And we'll get into that here in a minute. So thank you for bringing that up. Back to the balance sheet. Does anybody know what the 3 parts of a balance sheet are? Let's just look at them real quick. 3 parts of the balance sheet are your assets, your liability, and your equity. And there's a formula that we have to use to make sure that the balance sheet is actually balanced. The formula is assets equals liabilities plus equity. Let's take a look at some numbers for our coffee shop. We have 66,000 in assets. Our liabilities plus our equity equals our assets. So why is this important? This equation, balance sheets can get very complicated. But if your balance sheet isn't balancing out, there's a major issue going on in your bookkeeping. It's a very easy way to make sure that your books are actually in order. If everything isn't equaled out, there's something major going on that you did not enter, maybe got double entered, whatever it may be that you need to look into. So we need to make sure that every assets of the business are either funded by a liability, you took out a loan for a piece of equipment, or an equity is actually put into the company that the owner invested or kept their money in the business. So again, assets equals liabilities plus equities. So let's look at an easy balance sheet. This is a very, very, very simple balance sheet. Most of the time it's multiple pages, but this will be an easy one just to look at here. So we have our assets up top. Those are always going to be up top. And then we have our liabilities next and our equity next. As you can see, the equity and the liabilities are going to equal our assets. Some things that are in your assets are everything from cash. Accounts receivable would be jobs you've done that you just haven't been paid for. Inventory, long-term assets are going to be any type of equipment you bought. You bought a new truck for the company, you bought a new machine. Long-term assets. Current liabilities, same thing. Accounts payable would be you have to pay the utility bill. Is due in 2 weeks, but you're not paying it yet. That is going to be an accounts payable right here. For most businesses, a balance sheet, like I said, is going to be multiple pages because it can get very complex and confusing. But for a simple business starting out, we want to make sure that these liabilities and the equities combined equal our assets. If they don't, something's going on in your books that you need to look at. Okay, a cash flow statement. So as a small business owner, cash is everything. Most businesses go out of business because of cash flow, not because they don't have a good product or their marketing's off or they don't have good employees. The main reason is because they run out of cash or they don't manage their cash flow properly. So when it comes to accounting, there's 2 ways to really do accounting. These get a little confusing so I'll try to break them down. There's going to be 2 different ways. There's going to be a cash basis, which is the first way, which most small businesses are using at the moment. What that really does is a lot of times what's in your bank account right now is actually reflective of reality. And what I mean by that is the cash coming into your business and going out of your business is in a very quick time frame. So let's take a dog groomer as an example. I own a dog grooming business. I have a couple employees. You come to me for your dog to be groomed. You show up at 10 o'clock in the morning. We do everything. You show back up at noon to pick your dog up. At that time, you're paying me for my service, for the service of my company. So any expenses that I'm incurring to wash your dog, the water, the soap and everything is getting charged right there, and I'm getting money back immediately. So there's not a big time gap in between my expenses and when I'm getting paid for them. Sometimes I'm even getting paid before a lot of my expenses go out. I don't pay my employees usually until after I get paid for all the jobs, and I pay them on Friday each week. Cash basis is what most small businesses use just because transactions and everything are happening very quick. What most larger companies use, I think if you're over 25 million in revenue, you have to use accrual-based accounting. And what accrual basis basically does is take into account the timing gap that you have between your expenses going out and your revenue coming in. Probably the easiest way to explain this is let's take Walmart, for example. Everybody knows Walmart. Walmart is going to buy its inventory for its stores from all over the world. So Walmart needs to purchase that inventory probably 30, 40, 50 days before it even ends up in its stores. So they purchase that inventory, then it sits in their store for maybe a week or 2 before they finally sell it, and then actually collect the income from a customer. So there's a huge timing gap. It could be, 30 days, 60 days, could be even longer if it's inventory that's sitting on the shelf for months. That's when you take into account that timing gap. So when your expenses actually go out and when you're actually getting paid for the job. Another one is a contractor. A contractor buys their lumber to build a house. They buy the lumber, the sheetrock. They go to the house, install everything, finally give an invoice to the client. The client may pay 15, 20 days later. There's a little bit of a timing gap there. Like I said, most small businesses are going to use a cash basis accounting, which is totally fine. If you have a lot of inventory, maybe an accrual based accounting would be better for you. Is there any questions up to this point before I keep going? So let's just take a look at that, for example, with the coffee shop. Just like we said, cash is the most important thing. So I own a coffee shop. I'm ordering the beans, the milks, the pastry, everything at the start of the month, the start of the week, whatever it may be, so that I actually have product that I can sell. I need to pay these vendors up front. So that cash is going out the door. I also have to pay all my fixed costs. I need to pay for my staff, the rent, utilities, insurance, just to keep the lights on at the coffee shop. As I go through the weeks and the months, money slowly starts to trickle in from all those things that I already paid cash out for. The problem comes when the next cycle starts, when I need to start buying more inventory to restock everything, when I need to make sure that I can pay payroll in 2 weeks for all my staff, but it's been a slow week at the coffee shop. Nobody's coming in because it's 100 degrees outside. I still have to have money in the bank so I can keep the business operating. Just like I said, this is always the biggest struggle with businesses, whether you're small or large. Cash flow is everything. You have to make sure that you have enough cash in the bank to keep the business running and figure out how your business operates for timing. If you're a quick turnaround like that dog groomer, or you're somebody like this coffee shop where you better have a month or two of cash saved up so that you're always able to buy that inventory, pay your employees, keep the lights on, keep everything going. So let's look at just this, again, a very, very simple cash flow statement. For larger businesses, cash flow statements get extremely complicated. This one is very easy. We just broke this down. So we have our net cash from operations, like we talked about in our P&L statement, about $23,000. But look at the cash that we actually have at the end of the period. This is actually what's sitting in our bank account. So we made $23,000 this year through the business, but we actually have $49,000 sitting in the bank account. Does anybody know how that could be possible? Well, let's take a look at this a little bit closer. So we actually had a beginning cash balance of $20,000 in the bank account. So that helps right there. What we also did is open a short-term line of credit with the bank to cover those weeks where we need to make payroll, where we need to have more inventory. Whatever that cash draw may be, we took out a line of credit with the bank. So even though we only made $23,000 this year, between these two things, we actually have $49,000 in the bank. So I see a lot of business owners, which this is a good thing that you actually have more money. Most of the time it's the opposite where you have less money. But I see a lot of business owners just look at how much operating income did I have that year and say, oh, we're doing great. We made $23,000 in profit. But if you have more expenses going out than you actually have cash in your bank, you're going to be struggling to keep the business going. That's where this cash flow statement is very important for every business. So one last thing, what would happen if this owner says, gosh, at the end of the year, there's $49,000 in the bank. I want to go buy a new truck. I want to take my family on a trip. I want to do that addition at the house that I've always wanted to do. I had a great year. There's $49,000 in the bank. What would happen if they pulled all that money out of the bank? Just like we were talking about with cash flow, going into this next year, you'd have a zero balance starting off. And this is where businesses start to struggle. As a business owner, just because you have that profit or that money in the bank doesn't mean you can actually take that money out of it and go spend it on whatever you would like. Especially if you are in the growth stage, you need to make sure that you have as much cash as you possibly can in that business. Because if I took this $49,000 out of the business and I want to hire another employee, I want to buy more equipment, I want to expand a little bit, where am I going to even start that from if I don't have the sales coming in? You need cash. Cash is king for any business owner. All right, so let's jump into forecasting. Does anybody have a quick question about profit and loss, balance sheet, or cash flow statements? I just wanted to give a quick overview of that so everybody has a general idea before we jump into forecasting.
It might be a little in the weeds and something you might cover next time, but is this kind of the area where we use to calculate things like net burn and kind of projecting payroll and stuff like that, or is that more of, like I said, something you'll cover later?
Yeah, and that's something that for this workshop, we just don't have the time to go into that. If that's something that you would like to do, we could definitely schedule one. This is about just laying the groundwork. So that's a very good question, Kyle.
But this sets up the foundation kind of for all that, right?
100%. So going back to the original question by Joshua, why we're starting off with this, every business owner just needs to know these basic foundation so they can figure out payroll, so they can figure out forecasting. We're just setting the groundwork. If there is stuff, I was talking to Weston before this started, if there is very specific things that you guys are interested in that we don't cover this workshop, just because we're laying the groundwork, put that in the chat. Let us know at the end, because next workshop, next week, same time, same day, I'll be more than happy to dive into very specific things if that is what you guys need.
Perfectly
So let's
answers
just
my question. Thank you.
Yeah, no, that was a great question. There's so many different, ratios and everything to get into. It gets very complicated. So let's just do the basics today. If you want to learn more, I'll be more than happy to jump into it. So the three core parts of financial forecasting. So we have our revenue forecast. I'm just going to throw all three of them up here, then we'll talk about them. We have our direct costs, our COGS, and we also have our fixed costs, our overhead. So revenue forecasting, we saw in the profit and loss statement, our revenue, where it's coming in. And we even saw our different revenue streams in that profit and loss statement. We had our coffee and our pastries and everything else. This is the starting point that we have to start with. We have to figure out how this business is going to make money. Whether you're a current business and looking to scale or you're brand new, we have to break down your revenue streams that are coming in. And we'll jump into that a little bit further in the next slide. The second step after figuring out our revenue is figuring out our direct costs. Our direct costs, or COGS, is the actual cost of goods sold. So this is a direct correlation. So for example, when I sell a cup of coffee, I'm going to have beans that go into that, the milk. I'm going to have the cup and the lid and the straw and the napkin, things that directly correlate to the product or service that you are selling to a customer. And this will be calculated as a percentage. It can be in a dollar amount. A percentage is easier when you're forecasting. As you'll see, when we move ahead, you can use that percentage for any type of forecasting, any type of revenue amount that comes in. Our fixed costs, so we have two different type of costs. We have our direct costs and our fixed costs. Our fixed cost is something that's going to stay reasonably steady month to month. Now, with a growing business, especially just starting out and you're growing, the fixed costs are going to increase. Most of the time, from a month-to-month basis, they're going to stay reasonably the same. A year to year, they're going to increase for sure, but month-to-month, you can kind of stay, they're going to stay the same. For example, your rent. Most of the time you sign a 2 or 3 year rent lease, every month you're going to have the same payment. Insurance, it's going to be the same every month. When it comes to fixed costs, it can be the same thing. We're going to figure out a percentage, and that can help us go forward with it.
I have a question real quick.
Yeah, definitely.
So how do you like, for my example, hydroponics, you have to add your liquid fertilizer per so much per gallon of water. That's about 20 cents an ounce. How would you project that cost, or how would you put that in?
Yep, and that's where forecasting can get very confusing. So for the coffee example, we would actually break down, let's say I'm selling a cup of coffee for $10 just to make the numbers easy. I'm selling it for $10. The beans that are required to actually go into that cup of coffee are 50 cents. My lid and my cup are another 50 cents. My barista's time is $1 for each cup of coffee. So now I have $2 going into each $10 cup of coffee that I sell. Now, for every industry like yours, what we usually do is figure out all your costs that are going into it. So water, fertilizer, dirt, everything else. And we literally have to break it down to each revenue stream and then break it down to each unit sold. So it can get very complicated depending on what type of business you're in. But it's literally figuring everything out that's going into the business and then breaking it down to each unit that you actually sell. Now, with this, it doesn't have to be exact down to the penny. That's where a percentage can come in. We can just figure out a decent ratio of, like my cup of coffee example, $2 out of 10. So 20% is going to be my direct cost for every cup of coffee that I sell. Whether I sell 1 cup of coffee or 1,000 cups of coffee, it's always going to stay close to that 20%, because I know the beans are going to stay the same. The lid, the cup, the napkin, all that's going to stay the same price per cup of coffee I sell. Does that help at all, Joshua?
Sort of.
Well, let me go through a few more slides, and then towards the end, I'd love to use a real life example like yours, and then we can jump into it a little bit deeper. Does that sound good?
Okay, yeah, that's fine. Thank you.
Okay. All right, so we got our revenue, then we figure out direct costs, then we figure out our fixed costs. So let's just look at revenue streams again for this coffee company. I'm currently doing drip coffee. I'm doing all the fancy lattes, cappuccinos. I'm doing pastries, and I'm doing bottled beverages. And my company is just the coffee company is just kind of stagnant. I need to bring in different types of revenue streams to grow this business. So let's figure out some new revenue streams. I'm going to do breakfast sandwiches. I'm going to do some catering where I can actually bring in breakfast and coffee to board meetings, to whatever other type of gatherings there are. And I also have a connection that can actually sell whole bean coffee. So when it comes to forecasting, what we need to figure out, and this is a little bit different if you're a brand new business or starting. Let's say if you're starting a business, it's really what you would like to achieve. So at the moment, if this was a brand new coffee company, I've never sold a cup of coffee before, I need to figure out, okay, I think I can sell 1,000 cup of coffees this month, per month moving forward at $10 a piece. I think I can sell 100 pastries this month at $5 a piece. I'm going to sell 500 bottled beverages at $2 a piece. Forecasting is never going to be 100% accurate. Forecasting is very liquid. It's always changing. It's always moving. I tell people with a brand new company, be hopeful, shoot for your goal. If you think you can sell 2,000 cups of coffee a month, let's forecast for that. Shoot what you think that you can actually possibly achieve with where you're at. If you're a current business, I've already had this coffee shop for 4 years. I'm just looking to add these new revenue streams. Let's look at where we're currently at and where we're going to go with these new revenue streams. So with this next slide, I'll actually break this down for us a little bit. So for 2025, you can see these current revenue streams that we have going, and I'm already making money in 2025 with them. The 3 new revenue streams, I'm saying January 1st, 2026, I'm going to get these up and running. And that's where we start projecting in 2026. And as we continue to grow, this can be something that as a business owner, you just need to figure out how much you want to grow every single year. What's realistic. A lot of times with revenue, what we do is I say, shoot for the goal. Do you want to, double your revenue, triple your revenue? You want to have 4 employees in a couple of years? Whatever your goal is, let's forecast the revenue for your goal. And then we can figure out if that's actually possible. Some clients we've been forecasting and show they're going to make like $2 million or something in the second year. And it's like, okay, that's not realistic. Let's go back and actually find some numbers that are actually realistic for you and your company to do. Did you have okay, just make sure Jason didn't have a question. So with direct costs, we kind of talked about this, how everything that is going into the product that you're actually selling. We have the coffee beans, milk and syrup, cups, everything else. Fixed costs, like we talked about, that's going to stay mostly the same. We have our rent, equipment, salaries, everything else that's from a month-to-month basis is probably going to stay reasonably the same. So let's look at how that actually turns out when we actually have numbers in front of us. So with our direct costs here, we can see that as we increase, every revenue stream is going up and up and up. Our direct costs are increasing substantially because they're directly correlated to each product sold. So you can see in this 2-year span, our direct costs go from 117 to 253,000. So, over 2x. If we look at our fixed costs in the same time frame, we're going from 97,000 only up to 131. So even as our revenue and products sold are doubling, tripling, our fixed costs are still pretty much going to stay the same. So our fixed costs are the easiest thing to figure out for any business. Even with this, we did increase every single year. Our equipment costs went up a little bit. Our salaried manager went up a little bit. Utilities did. But these aren't something that are directly correlated to each revenue stream that is coming in. Does that make sense to anybody or to everybody? Does anybody have a question about the difference between fixed and direct costs? Awesome. So for example, we figured out that our direct costs for the coffee shop were 47%. We're projecting $25,000 a month in sales. We can see how this correlates to growth. We can use the same 47%, whether we're doing $25,000 in revenue or $40,000 in revenue that month, because our direct cost is always going to stay the same. This is something that when I'm working with people through forecasting is always kind of a hard thing to wrap your head around. Once we figure out what this percentage is, it doesn't matter what our revenue is. This is always going to pretty much stay stable. Now, you could argue it's going to change a little bit, but for the first couple of years that you're growing this business, this is always going to stay the same. So even if we're doing 40,000 instead of 20,000, we can take 47% right out of it as direct costs. So with our cost,
Question for you.
yep.
You said that doesn't change even if our revenue goes up. Briefly, why is that? It seems to me that the ratio would change. So this seems like a counterintuitive concept here.
Yes, it is. And it's really breaking it down, just like that cup of coffee example, where our bean cost that's going into it, our cup and lid. Now, once you scale up tremendously, you're going to get beans for a little bit cheaper. You're going to get the cost of the lid and the cup a little bit cheaper. But for a few years while you're growing, those costs of goods are going to stay the same. We have to break it down per unit sold. So every cup of coffee, I'm going to have the same expenses coming out of there. And those expenses are not going to change. So I can figure out that percentage per cup of coffee, and that'll be the same whether I sell 1 cup of coffee or 100 cups of coffee. Because I'm always taking the same chunk out of each cup of coffee that I sell.
So by tying it to the product instead of the overall business, we are able to then calculate and fix it and then forecast it that way.
You said it exactly right. Exactly right.
That actually makes sense now. Thank you.
Yep, and that's the hard part. Like when Joshua was bringing up his example, is really the breaking it down to the actual small unit cost of everything. That's the hardest part of any type of forecasting. But once we do, then we have that number. And you can see, like with this coffee company, oops, I went the wrong direction. Even once our revenue doubled, we're still going to have the same 47%. So you can see how everything correlates. Once you have this cost of goods sold percentage, you can do so much with it. And that's the most confusing thing. So if I need to do a whole nother, little section about how we would actually break all that down, I'll be more than happy to, because that's definitely the hardest thing to figure out.
But the value on it seems to be that, as we talk about increasing profit in the future and as we try and look at that, like you said, once we get bigger, we get maybe more beans at the same time, we have better costs and things like that. So profit seems to me not only just getting more sales, but also reducing that 47% number and finding ways to do it.
So going back to like the Walmart example, once Walmart's to such a big scale, they're going to be able to buy, every single shirt cheaper than when they were just 2 or 3 stores. But it does take a little while to get to that point. So like with the coffee shop, for example, maybe once I'm doing $500,000 in revenue, I can actually buy more beans for cheaper. So then that would reduce this 47% because my beans are less of amount coming out of that $10 cup of coffee. Maybe they're only 40 cents instead of 50 cents. So you're exactly right, Kyle. But for forecasting purposes, you only forecast out 3 years max, probably. We just need a starting point. Let's figure out what this percentage is and then go off that. Once the next year comes and we can do beans cheaper and the cups and lids cheaper, we'll recalculate and maybe this is down to 40% instead. Forecasting, people get stuck on forecasting because they think it has to be set in stone, that once you do it once, that's how it's going to be. And it's not. It can even change month to month depending on what's happening with the business. This is really just a framework for yourself, for any loans you're trying to get, just a starting point for people.
Thank you very much.
Yeah, no, that was a great question. Great question. So as you can see kind of in our forecasting right here, our profit and loss statement, you can see how everything kind of comes into play. Our revenue, like we showed before, and our direct costs directly correlate to that 47%. And these are numbers that were generated by the computer. This isn't stuff that I just put in. Once we found that it was 47%, the forecasting just uses that going forward. And it's easy to see, how much you're going to spend in each single item too. Because you can use that 47% and say, well, this is what I'm going to spend in this. Maybe I should go talk to my bean supplier because I must spend $10,000 with him. Maybe he's going to give me a better rate. So fixed expenses, going back to that, where hopefully it's going to decrease. So we started off high. Remember, we want this around 20% and we're at 43%. So let's see how it changes as we go. So the next year we had 380,000 in revenue. Now we're down to 35% because we have more revenue coming in while our fixed expenses are staying the same. As we jump ahead to that last year where we're doing 534 in revenue, how much our fixed expenses are decreasing every single year. That's a hard part. As a new business, your fixed expenses are going to be high no matter what you do, because you just have to get started. You have to get that building, you have to get the equipment, you have to get everything you need to get started. So fixed expenses are going to be high. The only real way to solve that is bring in more revenue, because then it's a lower percentage of what's actually going out as an expense. Any questions about that? Awesome. All right, so here's a scenario that comes up pretty much constantly with business owners I'm trying to help. So you're a business, let's say I'm the owner of this coffee shop. So I started it. I'm the manager and I'm the owner, because most of us that start a business, we're doing everything to start. I have a couple people working for me, a couple baristas that are helping me out, but I'm still the manager. I'm running the day-to-day thing. I'm working 10 hours a day, 7 hours a week, because I just need to get this business started. A question that always comes up to me with people is, when can I hire a manager? When can I find somebody to replace myself that is doing the day-to-day grind of things? This is where forecasting is extremely beneficial. So let's look at this example. So we're going to do two different scenarios depending on which year I'm going to hire a manager to take over myself managing the business. So this first year, both years, I'm taking a salary as a manager. I'm paying myself 60 grand to manage the business, and the business had a profit. So me as the owner, I get the profit too. I get the manager's salary and I get this profit. After 2025, I'm saying I'm burned out. I'm tired of working 10-hour days, 7 days a week. I'm hiring a manager. I can't take it anymore. The business is growing. I'm hiring somebody. So let's look at scenario B. So I decided to hire somebody. So I don't get that salary anymore because I'm paying a manager. The only thing I'm getting as a business owner is the profit that's left over at the end of the year. But since I didn't do any forecasting, I didn't really know how much profit was going to be left over. So I went from making $81,000 down to $58,000 because I didn't do a forecasting. Now let's say I stayed in the business. I said I'm going to make it one more year. So let's bump up my salary a little bit and I get the profits. Well, that's a big jump up. This is what happens to a lot of business owners. They just stick it out. I'm going to keep going with it. And then they end up making a decent amount of income. After 2026, now it's like, really, I'm burned out. I'm not doing this anymore. Let's see what hiring a manager would do. I don't get a salary this year because I hired this manager. But now that the business has grown so much, there's enough profit for me just as the owner to make $117,000. I can step away from the business. I can just be an owner, show up when I want, sit and talk with customers and pay somebody to run the business for me. But this scenario right here is what happens to a lot of business owners because they don't do a simple forecasting like this. They try to take themselves out of the business too soon, and the profit just is not there for them. And they actually reduce their income tremendously to a point that's detrimental to them. So hopefully this made sense. And this is just a perfect example of why, even as a current business owner, you really should do some type of forecasting. If you're trying to scale, trying to hire more people, this is where running simple numbers can show you whether it's going to be feasible or not. Okay, just some helpful tips real quick, and then I'll run into questions. And I can stay after noon for people that have questions and want to dive into their scenarios. So 3 financial statements. We have our P&L, our balance sheet, and our cash flow statements. What are the 3 components of forecasting? Like we talked about, we need to figure out our revenues, the first one, our direct cost, the cost of goods sold, and then our fixed costs. What's the difference between direct costs and fixed costs? The direct cost is always correlated directly to a product or service you're putting out. Fixed cost is just operating the business. And then what is COGS and how is it expressed? COGS is usually expressed as a percentage, and it's cost of goods sold. This is kind of a long-winded question right here. A lot of people ask, so how should I start the forecasting? Should I start at, what I want to make or where I'm at currently? How should we even start the forecasting? And when I work with clients, I say we can do either way. Usually I like to say, let's shoot for the stars. You want to make $100,000 this year. Let's figure out how much revenue you're going to have to do to bring that money in. Some people do it the opposite way, saying, well, I know I can only sell 10 snowmobiles this month. So that's going to dictate where I actually end up. Either way is fine, however you want to do it. We just need some type of starting point with your revenue to get started. Appreciate you guys' time today. Weston at Mission West is a amazing contact. If you guys have any questions, definitely reach out to him. I'm also another resource, but definitely want to push stuff towards Mission West. They're great for the community and everybody around here. I'd love to jump into something more specific. If you guys have questions, please jump on and let me know.
Yes, my question is, I guess since my business is a little different than others, is the hydroponics, so it's no soil, just water and fertilizer or liquid fertilizer. I'm using like an 80-gallon reservoir.
Okay.
And I have a system that doses it, how much water there's in there and doses it the right formula and everything already. I was just wondering how you figure out costs for like a liquid fertilizer. The power cost varies too, depending on the temperature outside because it's insulated and heated for all year round production.
So, yep, with that, so what is the actual finish end product that you're selling?
So we'll be roasting chilies, or selling chilies raw, strawberries, pepper mixes, and Armenian cucumbers.
Okay. So what we would need to do is actually figure out, like we talked about, start with your revenue first. How much in a given month or given year are you going to make from the chilies, the strawberries, the cucumbers, whatever other product you are going to have? So I'm guessing for you it's probably very cyclical, depending on the season. But we would break, or is it pretty constant for you?
I can do everything that's roasting until I figure out how to get it in a facility to do that. I'll probably just be during the summer.
Okay.
It'd be hard to do that during the winter time because it's a big roaster and
Yep.
propane and flames and stuff.
Yep, definitely.
But it
So
can everything can still be sold all year.
okay. So with yours will be a little tricky because you can sell stuff all year, but a lot of your expenses are going to be some upfront stuff, with the soil and the fertilizer. Is that just you buy that one time a year or is that a monthly expense for you?
Well, I'm projecting it'll probably definitely be monthly.
Definitely monthly. Okay.
Because it's a 3-part formula.
Okay.
So
that does make it a little bit easier. So what we need to figure out is what your monthly costs are for the water, soil, fertilizer in a given month, and then how much revenue you're actually bringing in from the chilies, the strawberries, the cucumbers in a given month.
I haven't started selling yet because I'm almost there, but
Okay. So that's where I talk about your hopeful goals. What would be your goal for a monthly revenue after selling everything? You're looking maybe like $1,000 we could just use for an easy example. So let's say you sell everything, those cucumbers, chili, strawberries, everything, you bring in $1,000 a month from selling all your products. Then we go to what your expenses are, the water, soil, fertilizer, everything else that goes into it. And we could say that that's $100 a month total, just to use easy math. So you're bringing in $1,000 and your direct cost for soil, fertilizer, everything else is $100. So that would be a 10% cost of goods sold because it's 10% of your overall revenue is going towards the fertilizer, soil, everything else.
Okay.
So now we have that 10% that cost of goods sold. And now you can really break it down into anything you want. You could break it down into each individual strawberry that you sell, because that 10% of that strawberry, whatever you sell it for $1. Well, 10% of that's going to be the cost of goods sold. So 10 cents out of that dollar strawberry you just sold is going to be the cost of goods sold. Does that kind of make sense, Joshua?
yeah, it makes more sense now. That answers the question.